Now I'd like to introduce our guest presenter. Ryan Hugh is managing partner with Hugh and Bordenave. I hope I got that right, Ryan. His practice focuses on business law matters, specifically business formation, buying, selling their businesses, obtaining licenses and permits, drafting contracts and filings. And his family of clients is diverse from professional fields, including dentists, realtors, developers, programmers, contractors, consultants, and professionals in food and retail services. So really, Ryan's clients are everyone. So it's so awesome that we welcome Ryan, and the virtual floor is yours.
Thank you. Thank you very much for having me again. And thank you for everybody who has decided to spend golden hour on well, I don't know if it's golden, it was raining earlier, but their afternoon Friday with me, an attorney. That's always a joy on Aloha Friday in the afternoon. But yeah, you did say my business partner's name correctly, even though I don't. I say it different ways. I say Bordenov sometimes. I think I say it to much of his chagrin. But anyway, today's topic, we're going to be running about how I got involved with this is I spent a lot of time working with entrepreneur types or startup types or even mom and pops that always pose the question of, hey, I'm launching a business. Should I have an LLC? That is usually the starting point of a conversation like this. But I also get a variety of questions related to that one of, hey, mom and dad have been running their liquor store for 30 years as a sole proprietorship or partnership. What should I do? Or, hey, I've had an LLC this whole time and I haven't really done anything with it. Is there something I should be doing? So what I'm saying is today's main focus is all about legal entities and how business owners come to the decision of either incorporating or organizing an LLC. And if there are some main takeaways that you take away from this afternoon, because business law is so legal soup, legalese oriented, because we create fictional entities and say those are legal persons, there are two things I kind of just want you to take away. If you're a small business owner or just starting out, you really should consider at least an LLC. But if you're going to go, and Greg is going to focus on his part on the fundraising and financing aspect, and going big is considering corporations. Though that is kind of one key takeaway. The other thing that I kind of want you to kind of hone in on or take away is how we attorneys kind of think about liability. Because for business owners, they're concerned whenever they turn to us, and that's what my business partner does with litigation, is, am I liable? Am I personally liable? What does this mean to be liable? And for us attorneys, the way we approach it when we're dealing with lawsuits or claims is very different the way a layperson. But I think for a business owner navigating their business and as they're growing through growth is being able to identify risk and risk mitigation strategies or being able to deal with it. So focus in on the liability. So those are the two aspects of form an entity, choose one, and how to deal with liability. Everything else is important. I'm not going to say it's not, but if you have to go cook rice, go grab your Uber Eats or whatever, I won't take any offense to it. It's just, those are the things I would like you guys to gather from it. So with that, I'm going to share my screen. And unless somebody has my slides, or are we gonna?
No, go ahead. And
okay. So I'm gonna share my screen.
Thanks, Ryan.
Just double checking. Okay, so kicking right off, title slide, as was mentioned, I've talked about this topic before, and the Business Law Corps did this for Restart Hawaii, so I'm just reusing my slides. Pace has these slides in a handout, so if they want to share it with you guys, I'm more than happy to say, yes, or I believe Greg has that authority because I gave them these slides and stuff, so it's under BLC. But either way, you can refer back to it and they'll be made available, I think, later. I think. Don't quote me on that. Okay, like any good attorney, I like to say, listen to this information, but understand it's just information. Nothing that I say is specific legal advice. And if you do need specific legal advice, consider scheduling with me or somebody who is more wise and sagacious like Greg and is very definitely key in on founder and financing type of fundraising type of situations. So again, take everything here as basic legal information and a starting point. It's kind of like a 101 course for business law. Okay, so today's agenda, we will be focusing on how I and other attorneys, business attorneys, kind of compare and contrast different types of business organizations. I like to use the word key factors, or you can consider them as comparison variables, but I'm going to run through all the different types of business organizations. And, you know, by me prefacing the too long didn't read kind of Cliff Notes version of, consider an LLC or corporation, you'll see why some of these other business organization types are not the most ideal for you as a business owner. But I need us to have the same basic kind of floor language. So we're going to talk about some factors, and then I'm going to talk about that critical idea of limited liability, which is why a lot of people engage in this situation of considering of an LLC or a corporation of, I want this limited liability. So with that, I'm going to hop down into it. Oh, by the way, that related issues to organizing are kind of what I feel are frequently asked questions in this area. I get a lot of people, potential clients, or people just asking one off, I read this on the internet. What do you think about this? So that related issues to organizing is kind of where those topics come from. On that note, I've been told if you could ask your questions, or we'll have a question and answer at the end of the webinar. Normally when I do something like this in person, I like talk story, but I think being a talking head on a video doesn't lend itself in terms of monitoring the chat and responding. So if you could let me get through the material and then Greg through his, I think we're going to stick around and do some Q&A. So just make note of what I'm talking about and then let us know what the questions are at the end. So with that, I'm going to hop into just the reiteration of what we're talking about today. So again, when people consider they have this great business idea, I have this idea for startup, I have a way to clean the planet and make money, I have a way to bring new, more cost-effective and environmentally friendly businesses to the islands. For us attorneys, the starting point, even before that idea is, well, what is the entity you're going to choose? What are you going to house this business operation? And because certain ideas and deals can be housed and owned by a business entity, and I'm talking about certain intellectual properties or contracts in terms of how you deal with potential business partners, we always kind of start with this, well, what am I going to choose? And choosing the right legal entity can save you a lot more headaches or reduce risk, as we're talking about. And for most business owners, they want to minimize their personal risk. That's where the limited liability, but they want to understand how this entity or why this entity kind of exists to limit that personal liability. But also with regard to liability, and I realize I've said liability a lot, but I'm an attorney, so we talk about that a lot, is when is the business liable and when am I personally liable, and when am I entering a situation that can increase or decrease that? So I would take that into heart. What's not on this slide that I will kind of focus on is the money aspect with regard to income taxes. I'm not going to talk about property tax. I'm not going to talk about the GET, but a lot of times when people enter this equation of entity selection, they also care about what it means for their personal taxes, their income taxes. So you'll see that throughout as I run through the organizations. So moving into the factors of what to consider when organizing a business entity. So first of all, there's cost and complexity. I sometimes code that factor as what I call formality. How much paperwork is involved? You know, administratively speaking, what am I going to do as a business owner? What do I have to put together to form or have this business entity? Is there anything?
Ryan, sorry, are your slides supposed to be advancing?
Yes. Is it not?
We're still seeing your title screen and it's not in presenter mode, but I wasn't sure if you wanted it to be in presenter mode.
Oh, oh, I'm so sorry about that. Thanks for catching that. Can you see it now?
Yep, agenda.
Okay, so great catch. Sorry about that. What I just ran through in the past 3 to 5 minutes was this agenda slide, this introduction slide about liability, where I repeated it like 5 times, and then the tax situation. And then we're hopping into under the agenda, these factors, this part of the presentation. So factors to consider. Topic 1, cost and complexity. What I said is formality. Yeah, that's all about the paperwork. How much are you going to have to deal with? Next one down is personal liability. Is the business owner liable? Is the business owner responsible for a dog bite on the premises or not? Yes, I love dogs, so that's whoever's dog was barking, that was great. But yeah, we're going to talk a little bit about liability. As I mentioned, we're going to talk about income taxes. The last one, these other 3, these are kind of related to the formality situation in terms of flexibility and perpetuity. And then for fundraising, Greg has some slides devoted to key factors for founders and financing. So I'm going to lay off a little bit of that so that he has enough. I'm sure he has a wealth of experience and knowledge, but he's going to touch upon that. So before we kick off things, and that's the rubric of the key factors I'm going to use to compare and contrast all the different organizations. Let's start with where usually people come to me is, hi, I'm a business owner and I don't want to be liable for anything. I'm like, great, we can get you partway there, but to eliminate liability, you might as well not do anything. But we have a way of limiting your liability. So limited liability is the thought of that when you form a business entity, that you as a person, an individual, when you contribute money or assets into the business entity, you're limited up to that. That is, if the business causes a situation of liability, whether it be contract or tort, so torts are negligence, slip and falls, all these kind of the things that my business partner does as a personal injury attorney is if I sue the business, am I suing you personally and individually, or am I suing the business entity? And you want the business entity to be sued, and you want the business entity to be on the hook for its liabilities. And thus, you're going to see we want separation. And that's kind of how limited liability works, is you're limited in your liability by what you put into the business. This is a very, very, very legally abstract thing. And if this is the first time you're seeing it, if you have questions about it and what it means in practicality or how it operates, we can talk about that at the end. But yeah, I need you to kind of focus on this and understand that in certain situations, the business entity will be a separate legal person from the business owners. That is, it's not a living, breathing individual like, well, I'm hoping none of you are bots, even though you know, we could deep fake your videos. But if you're a living, breathing person, that means something different than a legal person. So we use this concept of separate legal person to create this limited liability. Okay, so we're going to drop down to basic types of organizations. By the way, I know I have a tendency to talk very fast, drop pop culture references. Let me know if there is something that goes too quickly and I can retread it, or exactly as I was told, I was not sharing my slides. But anyway, basic types of organizations. So let's start off with the very easiest and simplest type of business entity organization, which is to say there is none. And that's a sole proprietorship. If you go on the side of the road and start selling lemonade or have a lemonade stand, or well, we're here in Hawaii, if you go on the side of the road and start selling mango or corn, and it's just you, that's a sole proprietorship. You have entered into a situation where you're selling goods or services. In terms of that cost and complexity, there is none because you are the business. You are just selling stuff. That is that all the profit and loss are directly made by the business owner. It's just them. The problem therein lies with the simplicity part is there is no limited liability because there's no separation between the business owner and their business because they are the business. So, you know, if somebody got sick from the mangoes or sick from the corn, they would directly direct their claim against the business owner because they're a sole proprietorship. The other issue with that is in terms of perpetuity is the business doesn't exist after the passing of the business owner because they are the business. This will be really critical to understand about LLCs and corporations, but I have a quick story here is I was helping a realtor transfer their business to their kids. They were a sole proprietorship. Unfortunately, they did not survive. It was not because of COVID, but they did not survive the transfer process so we could sign off and kind of change over the business. What that really meant for them in terms of licensing and permitting and why the perpetuity of a business existing after a business owner has passed on is everything was flash frozen. They were doing property management accounts for a lot of their clients, which meant the bank said, no, you're a sole proprietorship. The bank's accounts for your real estate practice are tied to you. And unfortunately, even though you're the kids and you're real estate brokers in your own right, you do not have ownership rights or you don't have access to the bank account. So until you resolve the issues of transfer in estate planning and dying intestate in terms of a last will and testament, the thing is that the client's accounts for the property manager were all frozen. Of course, their clients were very concerned about, am I going to get my money from my rent? So that really means something when the sole proprietor dies and they have a lot of these existing or in relationships, whether it be licensing and permitting or contractual relationships, like for property management. So that's why we care about perpetuity. In addition, because the sole proprietorship is the business, you can't really transfer any ownership of the business. It's not like stocks and shares that you'll see in corporation of how we kind of fundraise. So the only assets are physical assets usually that you can transfer. So, or intangible assets that you record. But the thing is that those are problems is when the business owner hasn't taken steps to formalize or create something. If something happens to them, that's it for the business. So that's why we tend to frown on sole proprietorships is the business owner is, and their personal assets are on the hook for everything. They're liable for everything. And that if they pass on or become disabled or incapacitated, that's really it for the business. Moving up a step above that is if I grab Greg or Crystal and we start selling mangoes and lemonade on the side of the road, we're now in a partnership. Again, it's a very easy, similar concept of instead of dealing with one person in a partnership, we're dealing with two or more people. And it's very much the same situation as a sole proprietorship. It's very simple. There's no paperwork. It's just two people carrying on for profit. Everything that the money, the business either makes or loses directly passes on through to the partners. There's no separate income tax return filing. It's just them. Again, the cons are very similar to a sole proprietorship, except the key difference being is that when you have a partnership, in that liability equation is that the partners are personally liable for the debts and liabilities of the partnership. And the partners can actually be jointly and severally liable for the liabilities that arise. What that means is that if you have a business partner, or if I do something stupid and jeopardize the partnership or business, that means Crystal's personal assets can be on the hook for something I did because we're in a general partnership. So that is, again, another reason why that we tend to frown on general partnerships. Yes, they're super easy to enter. It's just 2 or more persons carrying on for profit. But again, you're going to be exposing yourself, and your partners are going to be exposing you to more liabilities. So the other problem that I just kind of highlighted with sole proprietorships is that if a partner dies, especially if it's 2 persons, that's it for the partnership. There's no partnership. You can't have a 1-person partnership. It runs contradictory to the word. So again, the whole continuity of the business, whether it can own and be separated out for those purposes of liability, are of great concern to us attorneys, especially when advising business owner clients. It is true from a business owner's point of view that sole proprietorships and partnerships are super easy, but that isn't always a reason not to form an LLC or a corporation. So jumping down to where we get things are complicated and where we do start having formal business entities is the C corporation. So a C corporation is a very old form of business entity. Back when England, when we're colonies, well, not Hawaii, but mainland USA, were colonies, there were corporate charters issued by the crown and things like that. The corporation is a very old form. And really what it is it's a separate entity from shareholders. Shareholders are the people who own corporations. And what happens is when you're forming a business and you're trying to fundraise, and like I said, Greg will hit on these key points, you are exchanging stock shares, stock certificates for that capital investment. Notice in the sole proprietorship and general partnership, you kind of just start working and you're just working for yourself. In this situation, even if it is just yourself and you're starting with a small founders group, a lot of time you'll contribute cash or other types of assets into your corporation. And that's a good thing, because that's where that limited liability that we're talking about is you're contributing assets into the corporation. And it's you as a shareholder are limited to that amount. But now we see that in a corporation, they are a separate entity from the shareholders. That is the mechanism that we either use to contribute and be a part of the founding group, or we're seeking shareholders to invest more monies to raise more capital. Other features of that in terms of a corporation is it has perpetual existence. If one shareholder dies, it doesn't stop the corporation, it just keeps going. You can even have a situation that I did is I had a situation where all the shareholders died because they didn't take care of everything. But because the corporation still exists, we just had to go through some estate planning to transfer those shares to the new shareholders, which were the kids. And then they took over the corporation from there. Again, I'm going to leave this different levels of stock, going public, and fundraising for Greg, but those are also highlights and key features of a corporation. Okay, so the con. Yes, the biggest con of C corporations is they tend to be very hierarchical and complex. If you've ever seen a corporate tree of who the officers, directors, then employees like CEOs, CFOs, and COOs, all the way down to the mid-level managers and things like that. This is where, if you're using Microsoft Word or Microsoft PowerPoint, and then you go into those design slides or those smart slides or using those clip arts, you see these giant trees of blocks and arrows and things like that. That is where corporations, quote, quote, excel at, but also for somebody just starting out, what is all this paperwork? Why do I have to have meeting minutes? Why do I have to have shareholder agreements, subscription agreements? Why do I have to deal with all this paperwork when I just really want to be focusing on my product or service and kind of making the business or providing those services that I set out? And so that can be very intimidating. It's also why attorneys like me have a job to provide all this paperwork. But yes, a founder who is dealing with a corporation should be prepared to see a lot of paperwork. The other key feature of that's a con for somebody just starting out is that C corporations face double taxation. What does that mean? Notice when I was talking about sole proprietorships and general partnerships that I said whatever is made profit or whatever is made as loss on the business endeavor, that's it. It's just to the sole proprietor, or in the case of the partnership, it's just to the partnerships. They just file whatever money they made or lost as a part of their individual income tax returns. That is not the case in a corporation. A corporation files a separate corporate income tax return from the shareholders, who then, if they receive dividends out of the corporation, also gets taxed. Those dividends are represented as income to the shareholders. But the corporation, meanwhile, is operating as a separate entity, a separate legal person, and making its own money. So therefore, the corporation is taxed, and if that money gets sent out to the shareholders, that gets taxed as well. So that's generally presented as a con for C corporations. Okay, so moving down to LLCs. LLCs are kind of a nice halfway point between sole proprietorships and partnerships and C corporations. They generally are very flexible, and I'll highlight what that means. But as compared to what I spent on that con slide for C corporations, they generally have less paperwork. They tend to be very ideal for small business owners who kind of wish to remain small business owners, but it's in the name. They have limited liability like C corporations. They're a separate entity from what we call members. Members are the term we use for people who own LLCs or own what we call ownership interest or membership interest in the LLC. Most times you're going to just focus on the basic paperwork to set up an LLC, which are articles of organization, getting an employment identification number, and if you have partners, an operating agreement. On a word on that flexibility part and an operating agreement, the reason why some people choose an LLC over a corporation is corporations, in terms of their ownership and the stocks and shares, tend to be very rigid. That is, if Greg and I owned a corporation at 50 shares and 50 shares, if the corporation made $100 and we declared dividends, Greg must get $50 and I must get $50 of that $100 of dividends that get sent out. We split it that way. That's not the case in an LLC. And that's why some people, in terms of an LLC, treat it very much like what it is a partnership, a general partnership with limited liability. Is they're very flexible in the terms and the way they deal with it. We have a situation where Greg may own 51% of the LLC and I own 49%, but he and I can mutually agree upon having profit split 50-50. So in my scenario, again, of using that $100, even though Greg calls all the shots because he's the senior member, or he's the more, well, I don't mean that in the age way, senior member in the more sagacious, intelligent, wise way. He calls all the shots for the business, and I do all the legwork or kind of speaking or doing the services. And we can still say that, yeah, Greg, you call all the shots, but we still split the money 50-50. So that's why people like LLCs, because they're flexible. On that money kind of proposition, the other nice thing about LLCs even though they have the limited liability feature, there is no double taxation. LLCs do not file a separate income tax return from the members. Whatever monies made or lost from the LLC directly pass on through to the members. So in that way, you have the simplicity of sole proprietorships and partnerships, but you have the limited liability of a corporation. And so that's why I kind of present this as an in-between kind of step between what a situation where you're very put at risk and liable for everything versus a situation where you have some paperwork to do, but it's not as a lot as a C corporation. So are there cons? Yeah, obviously with that paperwork, with that formality or the cost administrative, you're going to have to do some paperwork. And I mentioned some of them. There are articles of organization, EIN, and an operating agreement. Because you're forming an entity, it's very easy to get turned around of understanding the issues of self-employment tax, especially if you're a first-time business owner. A lot of people take the idea of the LLC not having to file. I've had a lot of situations where people come to me with the problem of, I haven't paid income taxes. And I ask, why not? Oh, I have an LLC. And I'm like, that's not what that means. That means the LLC does not file an income tax return. You still have to. So when you're doing your taxes for the income or losses, it's very important to understand what that means for you individually. The other part is that if you're one of those business deal-making types, you're good at forming relationships, but not so good documenting things, you're going to find the flexibility actually kind of option paralysis, is that you have too many choices to make of how you can do your deals with your partner, especially if you're partnering off. And that can lead to very lengthy conversations about what goes into the partnership contract, which is the operating agreement for LLCs. So it requires a lot of thinking and in time investment powers. So that's another kind of con of the LLC. I'm gonna spend a very short time on S corporations because I think we're running on time, and I do want to give Greg his fair share because his stuff is very important while you're all probably here. But S corporations are kind of a halfway point between LLCs and corporations, if there is any, because really what it means is that the entity has filed an S election with the IRS, and it still remains a pass-through entity. But what it's really getting at is a situation where the founders or the people who have started the business entity would like to treat themselves as employees. This can be a fundraising mechanism, but S corporations tend to have a lot more restrictions than that can be a shareholder than a C corporation. In general, for me, it's only in a very limited circumstances. And if you guys have questions, we can address them there. But an S corporation isn't always the most ideal situation. I usually find myself only recommending this to professionals, attorneys, accountants, doctors, lawyers who really will remain a very small business, but because they're paid the way they are, that they want to consider the tax benefits or possible benefits of an S corporation. So I'm going to jump down into those frequently asked questions. So hopping back up to my agenda, where at the end part of me stop talking and we shifting gears, but we're now into conversion. So let's say you have a business idea, you're not really sure, and you just want to start out. You can start as a sole proprietorship, but as you've seen, it's not recommended. But it is easy to go from a sole proprietorship to a single member LLC. It is also easier to go from an LLC to a corporation. Generally speaking, the rule of thumb, it's always easier to make things more complex than it is to simplify them. That is, if you started off with a C corporation, and then went back down to a sole proprietorship, that probably would encounter you with a lot of problems, and you would need a lot of advice from an accountant and an attorney about how to navigate that. It's generally not recommended that way. It is, I'll put it this way, if you have a small business idea, sometimes it's better to start off as an LLC where it goes and then consider converting it at that point when you start getting more founders or financing backers and things like that. Today's presentation was focused on the main four, which was sole proprietorships, general partnerships, C corporations, and LLCs. I didn't talk about it. There's a whole bunch of other types of business entities, including I've worked with a lot of founders for nonprofits who are a little bit more into sustainability or charitable purposes, but you can consider that nonprofit corporations are another type of business entity if you meet, but I don't think they're your ideal goal for entrepreneurship and financing and fundraising. So these types of entities were not talked about, but there are other entities if you're interested in discussing them. Okay, so another question that I always get, and this is probably something for Greg to touch upon more because of everybody who's in the audience, is I always get, should I form my LLC in Wyoming, or should I form it in Nevada, or should I form it in Delaware? If you are going public, then yes, that is a Delaware consideration for a Delaware corporation. That is something that you would discuss. If you're doing anything else, if you're selling things online, if you are selling lemonade or mangoes on the side of the road physically here, then the site of domestication, and that's all that means is where you're organizing or registering your business. That's not really a question to ask of Nevada, Wyoming, or Delaware. You're physically here. You would have to register your business. And what we call that is a foreign business entity. Even if you formed your entity in Wyoming and you're physically operating here, you would take your Wyoming LLC and register it as a foreign business entity here in Hawaii. So a lot of times people read on the internet that they can avoid paying taxes or they can hide themselves or something like that. And really, that's not really the case if there's a physical kind of component and you're literally operating in the state. It's kind of hard to advise on that route. The only reason for the Delaware situation, again, is the benefits of that state if you're heading to some type of initial public offering. And that is a legitimate reason to consider forming in another state, is raising finances.
A quick question, Ryan. Can you, if you incorporate in another state like Delaware and then you change your mind, is it possible to change or no?
Yes. So not highlighted. That's a good question. And I think that's a perfect segue, and because I'm about to end and kick it over to Greg. But what's not in this conversion slide is there are ways to convert or transfer over your business. Let's say you're kind of in between two places, maybe, well, before COVID, I had a lot of clients that would travel back and forth between California and Hawaii, or California and Nevada, and they would operate their business. So it's legitimate to consider having the business in one of those states versus ours. And then they decided, oh, I'm going to permanently move into Hawaii. Yes, there are ways to transfer the site of your business, either through some types of conversion or transfer of state entity. And it just depends from state to state what the paperwork is called. But you can always move your business entity from another state. It just depends on where you're at and what you're considering on doing. Sometimes what we also might recommend is closing down the business entity in one state and just restarting as a fresh new LLC or a fresh new corporation with the same name if it's available in Hawaii. That is, I had a client move from New York and she found that her name was open here for use. So she just closed down her New York corporation and we just formed the Hawaii LLC with the same name. So I'm going to leave on this slide. And again, I think they're going to share these slides, but this is just an easy way to kind of compare the business entity types as a visual. These are just kind of noting what is possible, what isn't possible. And yes, you'll see with the C corporation, the LLC and S corporation that they're more costly and they can be more complex, but they have limited liability, whereas the sole proprietorship and general partnership don't. But of them, and I'm going to use this to now kick it over Greg, and I'm sorry I went over time, is the C corporation is good for fundraising. And I think founders really need to kind of hone in on that. And with that, that's.
I just put together a few slides for you guys. And I want to thank you for being here on a Friday afternoon. That shows real dedication, because I think if you're going to be a successful entrepreneur, you know, you have to put in the extra time. And so that's a really good sign. So I just have 5 slides, and I call them the top 5 founder recommendations. I don't know if they are, but I thought that would sound more interesting. These are 5 things that occurred to me. Hold on one second here. Okay, so the first is diligence your co-founders. You know, I've seen a lot of teams come and go at UH and outside of UH, and they're really surprised by their partners sometimes. And I think, especially like with students, you know, you meet someone in class or whatnot, and you feel comfortable with them, and you say, fine, let's do a company together. But, you know, that's like, you know, marrying somebody, you know, based on a Tinder meeting or something. I mean, I don't know what I'm talking about, because I don't know about Tinder, but, you know, what I know of it, you know, it's very superficial. And I think that smart founders will take a deeper dive into who is this person, you know. And so I've listed some of the things here, and there's ways of researching these areas, and I won't get into that, but what is my last drive? That's a typo. What did I mean to say there? Social media. Oh, drive. I do mean that. Are they motivated? I tried to come up with short words because it was a small slide, but how motivated are they? You know, because sometimes people are lazier than you think, you know, and you need to find out, are they going to go all in with you? Because that's a bone of contention. But I remember, this is like almost 20 years ago, there was a software company in Hawaii, and they were making some progress, presented to Hawaii Angels. Come to find out, the CEO was checking into OCCC every night. He was a convicted felon, and no one bothered to check. So, I mean, these things happen, right? So, I mean, did you even do a Google search on your co-founders, right? I mean, it seems like if they have a conviction, you'd want to know it, you know, before making a company with them. So let's see here. Put it down. Okay. Yeah, the picture's kind of corny, but basically work out your deal up front. You know, we don't want any broken hearts. And so a lot of times what people will put off, well, what's your equity? You know, how hard are you going to work? Who's going to do what? Are you going to do this after you leave school for UH students? You know, kind of have those, because it's much better not to do the company than to have a falling out. That's called a waste of time. So you don't want to have a false start that you could have avoided. Sometimes doing nothing is the best thing. And then when you do work things out with your founder, talk about the right things. And these are some things that occurred to me. You know, what are they going to do? How much time are they going to put in? What is the stock ownership going to be? What is the vesting going to be? Meaning what kind of work do they need to do to earn the shares? And then what are they going to get paid if and when the company has money? And so I think a lot of times people kind of cop out on this because these are hard things to discuss, but important things. Typically, there's a key founder that has to lead the discussion. I think sometimes with the business plan competition, there's like 5 people that come together and they're all co-equals. That's almost like a nightmare situation because how are they going to come to grips with it? Right? I mean, like, for example, Hoku Scientific was started by Dustin Shindo. He basically just told people what they're getting and they could, you know, take it or not take it. So, you know, he made it happen. So someone on the team has to take that leadership role. Protect your jewels. So, you know, this is basically intellectual property, but make sure you pay attention to protecting your trademarks, your patents, your copyrights. have a strategy. I know that if you talk to good patent attorneys, they don't just do one patent. They do a number of patents to protect put a fence around your company. And that all leads to your unfair advantage. So even down to having people sign NDAs or confidentiality agreements, or if you have co-founders, they should assign all their inventions to the company. So, I mean, these are standard documents, and just don't forget to do that. It's very easy to do and very bad not to do. And then my final, number 5 is always like movies, relating things to movies. So I don't know if you remember that Indiana Jones scene where they were looking for the chalice. And the German guy, Nazi guy, came up and he picked a fancy chalice and he melted. And then the guy there said he chose not wisely. And then Indiana Jones comes along and picks the really kind of humble looking chalice and drinks it, and that's the correct one. So as entrepreneurs, your success is not based on being careful to the point of not making decisions. Your success is, are you going to be able to make quick decisions and the right decisions? 90+% of startups fail because they make the wrong decisions, but you can't counter that by being so careful that you move slowly, because then you've taken away all of your advantage. So I've listed just a few things here that you need to choose quickly, but wisely. Who do you do the company with? Who do you choose as your mentors and advisors? And which market are you going to address with your invention? We had a client, about 20 years ago, and they had a medical device, so they could choose either hospitals or babies. Their device worked in both situations, and they chose babies because, I think they chose hospitals, but the negative to hospitals was the regulation. If they chose the baby market, it was a lower margin, but they didn't need to have the regulators approve it. So there are factors that go into that choice of what is your first market. Because if you choose the wrong first market, you're pretty much dead. You don't have time or resources to do anything more. And that's it.
I'd like to at least maybe do 5 minutes of questions. Does anyone have some burning questions? I'm sure we can take questions after the event if you want to email me, and maybe I can see if these guys will answer them after as well. But does anyone have any questions right now?
Yeah, hi. Thanks a lot, Greg. That was really helpful. I just have one quick question. What do you mean? So I know, it can be really bad if you choose the wrong market and it's just not a fit, and you've invested so much time into selling to that market and it just doesn't work, and your business just dies out because of that. But what do you mean, if you choose the wrong market, then it's over? Can you not just switch markets?
So no, I had a client, the client I mentioned to you did survive to shift, or like, for example, I'll give you an example. Hoku Scientific was creating fuel cells, and they went public, and they're the ones that fund the loan that Tracy mentioned earlier, right? The seed capital program. I think Hoku Scientific, Dustin Schindler did that. So he did well, but they were actually going to fail. But he pivoted to becoming a PV manufacturer, the material that goes into the solar panels, and he had a plant in Idaho and got funding and all that, but then the PV market went down because China started dumping the material. So you can pivot. The problem with the startup, though, unlike Hoku was a public company, if you're a startup with very limited resources, you're not going to have the money. You want to go all in on your market. Once you do that, if it doesn't work, are you going to be able to raise more money? Is that
right?
I think, and also it's going to be not as fast as it would have been earlier if you chose a different market.
Yep.
So while you could recover, it's going to be an uphill battle. You might want to just shut the company down and start again. But, by the way, I think Crystal asked a question here. Oh yeah, so if you go to businesslawcorps.org, the website that was listed in the chat earlier, you can actually go to a tool there where you can download LLC forms, because we just posted all the forms that we use. in practice. And so they're not dumbed down forms like LegalZoom. They're actual forms that lawyers use in practice. So, use them wisely. I mean, I think you probably want to get some help, but at least it gives you a good starting point. So yeah, that's it. And then there's a button, I believe, there for entrepreneurs, and that can lead you to the forms.
Thanks for your question. Any other questions while we have Greg and Ryan's attention?
Oh, by the way, I'm going to do the financing seminar. I'll probably be doing that one next month. So Ryan, I know, gave me a big, plug on that, but that's not happening today.
Yeah, sorry, I forgot you were doing a two-parter. Yeah, so
Yeah.
the finance, which is very key and very critical. So yeah, come back, and it will be minus me, so there won't be so much talking. And so Greg should have not minus 10 minutes for that, which you all probably care about in terms of raising financial backing.
So that's great. We'll have Greg return on October 22, so you guys can get all the good information about fundraising and financing.
We like to have Ryan here.
Yeah.
Maybe you can come, Ryan, and not talk.
I'm fine with that. I'm fine hanging out with you. I don't mind not talking, but I'm going to break that right now. But in terms of the LLC question, yeah, you're really looking for articles of organization, obtaining an EIN, and doing an operating agreement. There are some other attendant documents, especially if you're in what we call pre-formation stages. That is, you haven't formed the LLC, which still goes back to Greg's slides are great for strategic and thoughtful business partnerships of knowing who you're dealing with. I was joking about it, but my business partner is all the litigation side. So I like to joke that I form the businesses and he tears them apart. So the thing is having a good foundation, especially in an operating agreement, is very critical, and spending that time. But also, as Greg said, even for LLCs, protecting what makes your business special should be housed in an LLC and discussed. So again, I usually start off with articles, EIN, and operating agreement, because generally those would be the critical things that you would start a business bank account. And if you're expecting your business partners to contribute their cash, take all that cash and put it into that business account under the LLC. So that's why I usually start there.
Yeah, and Ryan does a lot of small business and startups in Hawaii. So if you need help, he's the man to go talk to. So I kid around, but it doesn't reflect on Ryan.
It's all good. It's all good kidding.
It reflects on me more.
No, it's all good. But
how about some more questions?
Yeah, if you have more questions.
Yeah, we can take
Anybody
one more
else?
question.
Because you got these high-priced lawyers, and then you're not paying for it. Well, you have Ryan anyway. So
when should you incorporate?
That's a great question, and I think Greg has it in his kind of slides. To answer the question about when you should incorporate, actually, oddly enough, I use the same strategy, exactly what Greg was highlighting about dating and Tinder. Do you really want to get married, because that's what a business partner is, to this person that you don't know? In terms of answering the incorporation question, there's no point in engaging in this work to incorporate and stuff like that if you don't trust your business partner. And because you're rushing to form a business entity, to highlight what I said about my business partner, a lot of times we see LLCs that do not have an operating agreement, but they have a deadbeat partner that is doing nothing. And I will always have people ask, do I have to really give him 50% of my profits? He's not doing anything. And I was like, well, what does the agreement say? There is none. I was like, well, you said they're 50-50. So yes, he doesn't have to do anything for his 50%. So to answer your question, it's not so much when you should incorporate. I always feel you should do it as early as possible. I do think Greg's slide there highlights you need to vet who you're going to be working with, because you will be married to them once you form this entity. Even if you've gone through the calculus of, hey, you're only going to get 20% and I'm going to get 80% of the company, they're still in your company. So in terms of the incorporation, I answer it usually as soon as possible, but in terms of the formalities attached to that of having business partners, I say do your homework and do your due diligence first on what the expectations are, because you want to marry up the formation of the business entity, and if it's an LLC operating agreement, or if it's a corporation, the shareholders agreement, and then all those confidentiality NDAs and those protections.
Let me just chime in real quick here. I think we're out of time probably, but let me give a more simplistic answer to Ryan's full answer. I think the time where you need to form your company, whether it's corporation or LLC, is when it needs to do something. So, you know, you don't need to form it really early, but if you need to sign a contract, or you need to, you know, do the business plan competition, or you need to, because I think they want you to have a company, if I'm not mistaken, or maybe at least have one in mind. But before you do a license agreement with UH, before you raise money, you know, these are all the things where you need a company. And so there is some advantage to waiting until you need it, because sometimes things change and it's easier to just not do something than to change it. So it is a balancing act, but I would just say the latest time you want to form it is when it has to actually do something.
You want to give yourself, to add on to that, if you go back to my slides about the liability situation, you don't, and exactly what Greg says, if you have to take action on behalf of an entity you formed, you need that entity. So you want to queue it up right then that I have this LLC or corporation, and I'm going to be signing as a member or as a president on behalf of that entity, to just have that synced up right at that time. Conversely, you could also have what's known as a paper or shelf company and just have something just sitting there. But Greg might be right. You know, you're just incurring administrative costs, just kind of just having something sitting there if you're not going to use it.
Okay, thanks so much for your questions, everyone. And thank you so much, Ryan and Greg, for spending your Friday, part of your